Welcome back to a brand new YouTube video. Today I'm going to be going over the Unicorn Model, which is a strategy that you can use every single day inside of the market. I personally trade Nasdaq, but this will work on any single pair or Forex or whatever you're trading. This strategy will work. I'm also going to partner this with an inversion fair value gap. Now if you've seen any more of my videos or you've been subscribed for a while, then you will know that inversions is the strategy I use daily. But also I do look for the Unicorn Model as well. So this video is going to be breaking down exactly how I trade, so you can kind of go back, do it yourself and get a hang of the strategy. If you didn't know already, then I do live stream every single day inside of my Discord. This is 9:30 to 11 AM New York time or 2:30 till 4 PM UK time. On these live streams you can literally copy my exact trades, also learn the strategy because I'm breaking down every trade that I take. So it's really helpful. If you would like access to this, in the Discord is in the description below. As well as that, the Alpha Futures discount code is at the bottom of the screen. They are my personal prop firm that I use. They've never denied a payout, they're extremely reliable and the rules are really good. So if you wouldn't mind, use that discount code, get yourself a nice discount on your account. And without further ado, let's get straight into the strategy and show you how to use the Unicorn Model. So jumping into the charts, you can see that I am on Nasdaq. And the first thing you want to identify when looking for the Unicorn Model is a Judas swing, okay, and that will typically be off open. So the market opens at 9:30, which is here, okay, and then what you want to see is just a big manipulation leg that just doesn't really stop going in that direction. So it can either be a big bearish leg or a big bullish leg, it doesn't really matter. As long as we get a big leg like this that clearly is just hunting liquidity, that is when you've got the first step of the Unicorn Model. Now, it's going to look something like this, okay? So if you've never seen the Unicorn Model or you're not familiar with how it looks, then essentially you just want to see a trending market that is clearly going in a certain direction. And then once we reach around the 10 AM candle, you're going to see something that looks like this, okay? And the unicorn is actually here, okay? Now, the reason it's called a unicorn is because this looks like a unicorn horn. It's actually just a liquidity sweep. And then an instant reversal back up. So we're going to be looking to try and take long positions somewhere in this kind of zone, okay, with our stops back below there. And that is essentially the Unicorn Model. It's really high risk to reward, and the win rate is around 30 to 40% when used correctly. Obviously everyone's results vary, but mine is personally 30 to 40% most months when I just use the Unicorn Model, never mind if I combine that with inversions, which is what I'm going to be going over today. So now that you know what we're looking for, and you understand that the first step is identify just a big leg in the market down. The second thing that's important is to make sure that you are trading inside of a macro. This is extremely important. Now the only time I take a unicorn setup is during a macro. Okay, if you don't know what a macro is, then it's the last 15 minutes and the first 15 minutes of every hour. Now in the New York AM session you'll have two macros, so you've got the 9:45 till the 10:15 and the 10:45 till the 11:15, sorry. So these two are the macros that we're going to be looking for a Unicorn Model. We're going to look for the actual setup. So it's going to look something like this. Now, when you're looking for this trade, you want to see that big Judas swing down, and then immediately you just want to mark out your structure levels. Okay, so here you can see we've got like an internal swing high. It's not the most clean or obvious one, but it is still an internal high. And then also here, okay. Now that is simple, just market structure. Now we're expecting that to continue down, okay? But this is where the Unicorn Model actually comes in and we catch the reversal, which flips all the way back up. The reason that this strategy works and the concept behind it is we use this macro because this is when the 4-hour candle closes. Now the unicorn is essentially the 4-hour power of 3 or an AMD on the 4-hour time frame. Now there's loads of different strategies that all come into this strategy. They're all called different things. But the unicorn is my personal choice that I use for the 10 AM candle. Now, if you don't know what that means, essentially at 10 AM we get a new 4-hour candle. Okay, so at 10 AM, this candle closes and we open up a new 4-hour candle. And of course, on the 4-hour time frame, price action moves quite a lot. Okay, so this 4-hour candle moved over 300 points. So we're trying to catch another 300-point move or something like that by using this strategy, okay? So that's the whole concept behind the Unicorn Model and why we trade during this macro. We're trying to catch that bottom wick on the 4-hour time frame and then catch the whole body in the opposite direction. So yeah, so once you've marked out your structure points, so we've got our highs marked out and we know where the swing low is right now, which is here. All you want to do is wait for a breaker structure. Okay, so here you can see that we just continue down. We've got a high. We have now made a new swing low in the market, and we have actually just swept liquidity to the left there. Okay, so we've had a sweep on sell side liquidity. We are inside this macro, and we are clearly very low in the range. Okay, we're massively in discount, so we want to be looking for long positions. Okay, now that we've identified that we've got a liquidity sweep, okay, all we need to see now is another high get broken. So we need a break of structure to the upside. Now, you can see that before I actually had this high marked out because this was the previous high in the leg. Now that we've actually made a new swing high, which is here, okay, because we've come up, we've formed a high, and then we've pushed back down. This is now the new internal high that we're going to use for our breaker structure. Okay, so all we need to see now is candles close back above this high, which will look something like this. Okay, so you can now see that this bullish candle has broken structures to the upside. We have actually broken this high, which now means we have got our bullish breaker structure. This is now where we can start looking for the unicorn model. You will also notice that we inside of this leg up, we have actually inversed a bearish fair value gap as well. Okay, so that's where the inversion fair value gap comes in. Okay, we've inversed this bearish fair value gap with displacement. So this is also a bullish confluence telling us that we are now going to go up and this low will be respected. Okay, and this is telling us we're going to go higher because the buyers are now taking control and are inversing bearish fair value gaps. So that's another good confluence to look out for if we do inverse any gaps. Now, the way you're going to enter a trade using the unicorn model is by using a breaker block. Okay, and a breaker block is the last candle before the sweep. Okay, so this candle here is the last candle before we actually get that last bearish leg down. Okay, so if it was here, for example, this bullish candle would be the breaker block, okay? Because this is the last bullish candle before we get that bearish leg down, okay? Do you understand that? Like, it's literally just the last candle of the opposing side before we get that manipulation leg, okay? And if we take it to another side, you can see we sweep buy side liquidity here. This would be your breaker block because this is the last bearish candle before the bullish sweep. Okay, surely that makes sense. It's pretty simple. It's just the last candle before a sweep. So in our example right now, this is the last candle of the opposing direction before the bearish sweep. Okay, so this is our breaker block. Now, once you've marked that out, this is what you can enter off. And you can also partner that with any fair value gaps left behind. And you can see here we have left behind a tiny 1 minute bullish fair value gap. Okay, so this is now the perfect entry to get in longs. Okay, once we tap this fair value gap and retest this breaker, that is when we can look for longs. Okay, so this is now where here I would set my limit order. So I'd set a buy limit there. Okay, my stops would go back below here, which I will put in once I've been tagged in. And our TP is going to be buy side liquidity. Okay, so you can simply do that by drawing your Fibonacci out from high to low of the range, and you want to mark out your buy side liquidity levels. Okay, so here we want to be targeting discounted range. So anything above 50% is a good TP because that's where we can expect a retracement. So this internal high is going to be our first target, and our overall TP is going to be this resting buy side liquidity up here. Okay, and that is our two targets. So I've played the candle through. You can see the next candle comes down, tags us into this trade. We are now inside of this trade, and our stops are going to be back below the most recent low, okay, which is here. You then can move your TP to our external high, and once we hit this 50% level, that's when you can close half your position, or 75% of your position, depending on how confident you are of hitting the full TP, and then also start trailing your stop loss. Okay, the reason we expect a retracement to 50% is because for price action to move, we should always go from premium to a discount. So right now we are massively in discount of this range for longs. So we want to see price come up into here, and then maybe we retrace down. We do not know if we're going to go all the way up, but what we can expect is at least a 50% retracement, and that is why we target 50% of the range, because market structure tells us that we should at least fill these orders from these bearish gaps, okay, rebalance the market, and then if we want to continue bearish, we can do, but we've already closed the majority of our position, and we're probably at break even. okay? And you'll see as I play through, we do eventually come up and hit our 50% level, okay? So there is our first TP. Now at this point, this is where you can either close 50% of your position and let the rest run, okay, to external buy-side liquidity, or you can just start trading your stop loss, okay? Now in this example, I've entered with one contract on NAS, so I can't actually close partials here, but personally, I would close the majority of my position here and just trail my stop loss to break even. And the reason we do that is because, again, like I've just said, we are now in discount of this overall range. So if we are going to be bearish, this is going to be a good place to look for shorts. And not only that, we have left behind bullish PD arrays. Okay, so we've left behind a 1 minute bullish gap. Now, if we're going to be bullish, we do not want to see bullish fair value gaps get broken. Okay, if bullish fair value gaps start getting inversed, that means that the buying pressure is not enough to take us up. Okay, so essentially, our stop loss can go below this fair value gap, because if this breaks, then the sellers are taking control anyway, and we're probably going to come all the way down. Okay, so this is where you can start bringing your stop loss up very tightly and just keep following it all the way up, trailing it higher. Okay, so every time we make a new high or a new fair value gap, you can actually do that. Okay, so here we inverse this bearish gap, so I am now out of the trade because the sellers have now shown me that they might be taking control of this market. We are delivering from bearish fair value gaps, and we're also inversing bullish gaps. So this is why I would close my trade there, and that is a successful unicorn model. Now I'm going to jump into another trade example now, okay, showing you the unicorn model again, and then, again, this is going to follow all of the criteria that I've just gone through. So we are inside of a macro time frame. We have had a big Judas swing off open, which is this big bearish leg, okay, and we know we are bullish because we are extremely low in the range. We have taken out all sell side liquidity below, okay, we've started forming bullish structure, and we have got a swing high, which is our overall target for the day. Okay, now you can determine your bias pre-hand. Okay, you don't have to come into this and just wait for a Judas swing. You can actually determine your bias before you look for a trade. I've got videos on that uploaded to my channel, so if you don't know how to find your daily bias correctly, then go back to my channel and you will find my daily bias video. But on this specific day, I was bullish, so I was looking for long positions from a unicorn model. So now that we've got our bearish structure, okay, we've got our bearish leg, which has come down, clearly taking out sell side liquidity here. Okay, this is where we can start looking for our breaks of structure to the upside and our fair value gaps. So firstly, we need to see structure formed and a clear and obvious liquidity sweep. Okay, and you'll see here that we have just exactly done that. Okay, so here we have just swept these lows, okay, extremely cleanly, because look at that reaction. We got a huge wick down and we also flipped back up and didn't close below. So this is still maintaining bullish structure. All this is a liquidity sweep. Okay, so now that we've swept those lows, and there is the unicorn horn. So like I was saying, you need to see that liquidity sweep and then the quick flip back up. Okay, so here, there's the unicorn. We sweep down, we take the lows, and then we flip back up. So we're now waiting for that next leg that takes us up, and then our breaker block entry in a continuation model. So we swept these lows. This is now when we need a bullish breaker structure. So we need candles to close above this high, which we get here. Okay, so now that we've broken structure to the upside, this is now where we look for our entries. We know that we're bullish, okay, our bias is bullish. We've had a clear unicorn model, we've swept sell side liquidity, immediately flipped back up. This is now where you can start marking out your breaker blocks and your fair value gaps. So here, this is our breaker block, because this is the last bullish candle before the bearish sweep. Okay, so the bearish sweep comes down, takes out sell side liquidity. This is the last candle, so we mark that out. Okay, and like I said before, we mark out bullish fair value gaps as well, because that's what we're going to enter off. So here we leave behind a 1 minute bullish fair value gap, which is also overlapping this breaker block. So again, here you set your buy limits and you wait to be tapped into this trade. The next candle comes down, almost wicks us in. We then get tagged in perfectly. Okay, and this is now where you can start moving your stop loss to the most recent lows. Okay, now in this example, we're not going to use a huge stop loss because this is the most recent swing low technically, but the stop loss is over 60 points. Okay, so in this example, when your stop loss is going to be this big, simply just put it below the breaker block. Okay, because the breaker block is an extremely large PD array on this trade example, and we've got a lot of wiggle room to bounce in and out of this. So if we do end up breaking this breaker block, then we're probably going to come all the way down. So that's why we can kind of hug this breaker block tight with our stop loss, because if we disrespect this, then we're probably wrong and we are going to go down. Okay, and here you can set your TP at that external high, because we know we're bullish, our daily bias is bullish, and we have got a bullish unicorn model. Okay, so we're now in this trade. I can get rid of this macro time frame, and we can start taking this trade, okay, and following it up. Okay, now once we take out this buy side liquidity, this is now where we can start moving our stop loss to the most recent swing lows. Okay, so here we're now $1,000 in profit. We can start moving our stop loss into profit, because we are now confident that we are right about the day. We are right about our bias because we've clearly pumped up, and we do think that we're going to target this external high. So like I said previously, we do not want bullish PD arrays to be broken. If we're going to be bullish, then we want these to hold. So if we put our stop loss below this gap, that is just protecting our risk and also guaranteeing a little bit of profit, okay, just in case we do end up coming down. Now essentially all you're going to do is just follow your stop loss all the way up behind every single low. So now you can see that I have at least secured $1,000 profit right there, and I'm still in the trade with my max position. I haven't closed any partials at this point. I'm still in the trade with a full position, and I'm guaranteed to make at least $1,000 right now. Or I hit full TP and make $2,000. Once we make a new low, we start trading our stop loss, and now we are almost at TP. So this is where we're going to hit full take profit. So as you can see there, we just hit full take profit, and that is why we trail our stop loss up to guarantee the most out of the trade. This was a full TP. It was a huge trade, and if I actually show you the risk reward on this, it was insane. So here we started out with actually a 2.6 risk reward, but the second we get that leg up, which breaks that high, we immediately move that to, you know, minimal risk, which is like a crazy 6 risk reward trade. And once we took out this internal high, we'd gone completely break even and actually moved our stops in profit. So this started out as almost a 3 risk reward, but realistically, with this kind of momentum, you know, your risk reward's a lot higher. But yeah, that's going to be it for today's video. Thank you very much for watching. Once again, please like this video, subscribe to my channel. We're on the road to 1,000 subscribers. We are literally going crazy right now. I think on the last video we were on 740. At the time of recording this, we're on 840. Like, this is crazy. So yeah, if you don't mind, subscribe to the channel. Get me to 1,000 subscribers so I can start getting monetized and making money. But yeah, I appreciate you watching, man. See you in the next video.